Hey Dividend Growth investors, bonjour, Mike here. Today we are inside DSR in part of this video series on how to invest a lump sum amount of money in 2024. I've given you some ideas. I showed you that it was really important to start investing, and today we're going to talk a little bit more about portfolio management, how to set up that portfolio to make sure it's well invested, well diversified, and even if you are in the middle of a crash, you still buying quality investment. Tomorrow will be the last video of this series, and tomorrow we're going to talk about the timing. So make sure that you like this video, subscribe to the channel, and turn on the notification to not miss tomorrow's video, because I know that if you have been waiting on the sideline, it's because you are afraid of a market crash. And tomorrow I will be providing you with my strategy to avoid paralysis by analysis, start investing without getting caught in the middle of a market crash at the same time. All right, investors, now we're going to go inside DSR Pro, and I'm going to show you how I've built my portfolio, because in 2017 I was exactly in the same situation as you are today. We were at a all-time high market. I received a big check from my previous employer, and it was time to invest that lump sum amount of money, and we're going to see how it looks today. All right, so what you see here is my DSR Pro dashboard for my pension plan. You can see it's written right here, pension plan. This is the portfolio that I built after receiving a check in 2017 from my previous employer. So it is a locked-in RRSP. So for my American investors, that is a retirement account where I cannot add capital or I cannot withdraw capital before retirement. You know, when you're thinking about building your portfolio, the most important part will be your asset allocation and then your sector allocation. So looking at the asset and currency here, as you can see, I'm 100% invested all the time. So 100% in equities. I've been doing that since 2003, so I did not hesitate to put all that money to work, because I know that time in the market is the most important thing. On the other side, you can see that I have a slight preference for the US market, even though I'm Canadian. So the portfolio is 57-43 in favor of US stocks. The reason why it is so high is actually I started it at 50-50, but as you know, most of the time the US market outperforms other markets in the world. So this is exactly what happened. Actually, a few years ago, I sold a few US shares to bring back more money into Canadian dollars. And again, I would have to do it again if I want to respect that 50-50. As long as it doesn't go above 60-40, I am still good with that. The most important part, once you have determined your asset allocation and your currency allocation, is then to go into sectors. Of course, we could look into preferred shares, into bonds and stuff like that for the asset allocation, but I am a dividend growth investor, so I don't really mind about the fixed income, and that video is all about investing in equities. The fixed income is relatively easy. You determine how much volatility you want in your portfolio or not, and then you put a good part of that portfolio if you don't want to have volatility at all, and you do that with an ETF on bonds or a bond ladder, and then you are set up. It gets a lot more tricky when you look at sector allocation. So from this one, what you see here is I have a massive exposure to the financial sector with 31.5% of my money invested in the financial industry. Of course, you're going to tell me, oh, Mike, you probably have like a bunch of Canadians. So the first thing I do whenever I see that I am above 20% for a specific sector is I will look at the composition of that sector by stock. So here I see that the first one I have is Brookfield Corporation, ticker BN, which is an alternative asset manager. The second one is Visa, which is, I could like categorize it probably like 1/3 financial, 1/3 technology, and 1/3 consumer discretionary, because if people don't travel and use their cards, chances are they're going to make a lot less money. So overall, I'm not too concerned about this one. It's not exactly a pure financial play here. The next one is BlackRock, which is what I would call a regular asset manager. It's actually the largest asset manager in the world, mostly driven by ETFs and solution for institutional market. So with Brookfield Corporation and BlackRock, I have two types of different asset manager, and I have a payment processor with Visa. And after that, I do have two banks, so Royal Bank and National Banks, that are the two last item in this sector. So even though I have 31% in that specific sector, I have invested in a regular asset manager, an alternative asset manager, banks, and also payment processor. So I have like 4 different types of industries inside the same sector, which provides me a little bit more of a buffer if there's anything that happens versus someone that had 5 or 6 banks and then we go into a mortgage crisis. Well, then that portfolio will be up to a great decline versus this one that I've built. The second thing I want to talk about when it's time to look into sector allocation is I love to invest in sectors that I understand and I am comfortable with. One sector that I don't really like is actually the energy sector because it is quite volatile and those businesses depend on the commodity price fluctuation. So when the oil barrel natural gas is up, well then you look like a genius because those companies, they're buying back their shares, they're paying off their debts, and they're distributing dividends like it's candy on Halloween. The problem is we all know that the oil barrel and the natural gas spot price goes up and down all the time. So when it goes down, well, they get into more debt, they do some cutoff, they stop paying their dividend or they reduce it, and now the stock price decline. I don't want that in my portfolio because I want to invest in companies that will grow their dividend every single year. Another sector that is similar to that is the material sector, and you're going to tell me, but Mike, you have 8% of your portfolio in that sector, which totally true, but when you look at what it is, well, we have Stella-Jones that are selling utility poles, railway ties, and residential lumber. So yes, it is tied up to the price of wood, but the utility part, the utility poles and the railway ties are more like a repetitive purchase, sticky business model, and this is why I have it in my portfolio. The next one on the list, CCL Industry, similar to Stella-Jones, they are dependent on commodity prices. This one is all about packaging and labels. So it's more about the price of chemicals that will affect their margin, but they do sell a lot of repetitive purchase products. They are diversified across several business segments and also geographically, and this is a reason why I have it in my portfolio. So as you can see, what is really important at this stage when you have kind of like your buy list is you plug them in a software like this one, like Dividend Stocks Rock, or you can just do a good old Excel spreadsheet that will do the work just to classify each of them per sector, and then you can analyze if your buy list makes sense as a portfolio or you just selected too many stocks from the same sector or the same industry. I like to have a wide diversification of sector in my portfolio. As you can see, this is exactly what's happening there, but I'm not necessarily limiting myself to specific sector or I completely ignore those. What I'd rather do is use a stock screener to start and build my buy list. Right before we go into the stock screener, I just want to talk a little bit more about diversification and ratings. I think it is super important to rate your stocks. At DSR, we do have 2 types of ratings. So we have the DSR Pro rating and the Dividend Safety Score. They are from 1 to 5 each of them. So the 1s and the 2s are bad. The 3s are in yellow, they're okay. And then the green ones are the 4 and the 5. So you're trying to have as many green as possible in your ratings just because it is an appreciation of the dividend growth perspective and the overall business model. On our side, we focus a lot on the dividend triangle, which is the growth of revenue, earnings, and dividends. So we look at the trends of those 3 metrics. So the 3 metrics creates the base of that dividend triangle. And the key is to find companies that are able to increase their sales and then make more profit with that, and obviously share the wealth with shareholders. One super important key here is the dividend diversification if you are about to retire. So you need to know, yes, how you are diversified in terms of stocks and sectors, but also where your money is coming from, especially if you depend on it to pay your bills every single month. So as you can see here, my largest dividend payer is National Bank in this portfolio with 11% of my dividend income. So nothing goes above 15, even like 11 is not that bad. And National Bank has the lowest payout ratio among Canadian banks and is the most generous dividend payers in the past 5 years in terms of dividend growth. So nothing to worry about here, but if you have any of your stocks that have like 15, 20, 25% of your dividend income, maybe you want to revise that. So as you can see, I do prefer to have a wide diversified portfolio across many sectors, across many dividend payers, and I focus on quality. The current yield of my portfolio is actually 2.10, which is not that much, but what is great is the 5-year dividend growth rate over the past 5 years on an annualized growth basis. My dividend portfolio increases dividend by 10.59% every single year. So I focus on quality rather than on yield. So how do you find those stocks? Well, how do you find those stocks is not that complicated if you have a strong stock screener. So what I do here is on my stock screener at DSR, we have the ability to create your own filters. And the one that I love is the dividend triangle filter that I've created. The dividend triangle filter is quite easy. So what I do is I have minimum pro rating of 3 and dividend safety score of 3. So what I make sure here is companies that are okay to good. So I discard all the bad stocks and then I can start looking into companies that are doing a little bit better. Then I put a minimum earnings per share, revenue growth, and also dividend growth of 1% annually over the past 5 years. Again, the key here is to have something that is positive, but that not necessarily being penalized because they had a bad couple of years during COVID. So with this filter, I go from 1,100 stocks to roughly 371. So we're still way too many stocks here to identify the one that you love. But then what you can do is you can filter by market, so Canadian or US depending on what you like, and then you filter by sector. So if I look at the communication sector, then I realize that I don't have many stocks here on the US and Canadian side that has a positive dividend triangle, so I might not necessarily look into this one and skip to the next sector. So as you can see, sometimes it could be easy, sometimes it will be a little bit harder. So for the consumer staples, we have 27 stocks. But then you can filter by dividend growth. So I would always favor the one that shows the largest dividend growth and start looking into them. If I look at Medifast, for example, which is the one that shows the best metrics, earnings per share, revenue per share, dividend per share growth over the past 5 years are amazing. So let's take a look at this one and see how it looks in terms of numbers. We don't cover this one at DSR, but we do have the dividend triangle. And here's the important part here. While the numbers were amazing, it's because we started in 2018 and then we ended up here. But now we can see that both the revenue and the earnings are slowing down and there was no dividend growth increase so far. So now you see that you cannot just look at numbers, you look at the trend. So that is one super important part where I look at the dividend triangle as a company like this one. I'm not really impressed. And that also explains why the stock price is going down. So this one would not be part of my list. On the opposite side, you know me, I'm a big fan of Alimentation Couche-Tard, so let's take a look at this one and see how it goes. I do have the full analysis here, but I want to focus on the dividend triangle for this, for this example. This is the type of company I would not hesitate to invest in, even if I had a lump sum payment today. What you see here is strong revenue growth, even though we had a slowdown right there. That is coming from the COVID, obviously. But what is most important is while you have a drop in the revenue, which explains because they sold less fuel, the earnings remain stable during that period of time. And what is more important is while they have earnings per share around $1.50 back in 2018, now they have more than double that in 2023. So that explains that even as the stock price is on a rampage right now, close to $80, you're still paying similar the same price that you were paying 5 years ago. And then obviously, once you have a look at the earnings per share, you can see that dividends are growing super fast. So this is how I would build my buy list, by selecting the cream of the each sector one by one, doing that research, and try to have like maybe between 20 to 40 stocks where you feel very confident in those, and now you have your good buy list in different sectors, and then you are ready to pull the trigger to start investing. How are you going to do that? Well, that is coming tomorrow with a strategy to avoid being hit by a market crash like it was a train. So don't forget to like this video, subscribe to the channel, and turn on the notification to not miss tomorrow's video. And until tomorrow, don't forget to stay invested.